with economic challenges worldwide, and India is not extremely high on insulation from global factors. This time around, I think we have fiscal challenges and economic challenges, just that the trigger point is the virus, and the threats of the virus are as big, and that can lead to a further spiral on economic and financial crisis. Just to give everybody a flavor on what are the challenges we are battling at this juncture, and more than happy to try and contextualize a lot of the discussion around that as well, because that is the overhanging thing that exists as a ground reality today, and none of us can authoritatively predict when will normalcy arrive. And I think when it is as acute as this, and when we just don't know when things will be normal, this is broadly the new normal, if I can say that in a slight lighter vein. Of course, we all hope and pray that this is staying for too long, but yeah, for the short term at least, and a little longer for reasons that I will just talk, we do expect this to be a medium term normal. So we, over the last 4 quarters or 6 quarters, when you talk about markets, financial markets are not only startups and private, they're also liquid markets, listed markets, currency markets, etc. And there were undercurrents which led people to believe that there are going to be strong challenges. Uh, People used to ask questions around what is keeping some of the markets in the world up, including the Indian markets. Fundamentals do present a slightly different picture. And people used to talk about this, some of these blogs would write about the fact that there will be winter soon. People were expecting challenges, and the we all saw was the liquidity crisis in India. Uh, and that, in some sense, was driven with the NBFC sector, banking challenges, and local growth rates not being as high as we would have liked. And world externally also was going through its own challenges. And then we have the virus. So these things can throw lives out of gear. These things can deprioritize most of the things that we wanted to do, and make it imperative for us to just get into managing with whatever little we are left with. So yeah, these are the ground realities that exist today. For depending on which part of the country you were, if you were in Bangalore, the last week was around figuring out life and working on BCP, figuring out work from home, etc. For people in Bombay, this week did start on a bit of normal, where you saw trains being full and traffic, red lights having some traffic. But as each day has gone by, we have seen things kind of having a small tapering down. Oh, and there have been cases that are being diagnosed every day. Today, what I'm told at least is that we don't have fresh cases, at least so far. But broadly, at least for the next 2 weeks, ain't going away. And people are saying that even if we have to bring things under control with great amount of commitment and some degree of magic, next month will be like that. So what is it that led me to say for medium term, if this is about 1 or 2 quarters, things will be like that? And then I'll quickly turn it over to Sanjay to kick off the core of the session. The reason I say this is going to be a 3 to 6 month scenario and would want everybody to think about it in that fashion is because by the time things will turn to normalcy, and let's hope that we are able to bring the virus under control, uh, we'll be definitely towards April end. This is a best case scenario. And in a best case scenario also, for numbers to come back, for teams to get back into the momentum and motion. I know most of us have managed to get BCPs and work from homes and all that, but still it takes some time for customer resonance to happen, for commerce companies. It takes some time for B2B dependent companies to get in motion again. So it will not be until end of quarter where we get all engines firing. And if we have to talk about funding activity or normalcy, September quarter is the earliest when we can show that what happened until February, and then what was a normal situation, and after that we can show the curves back moving up. So those waiting for funding, that's a timeline. Those waiting for complete normalcy in quarterly numbers, that's a timeline. And then let's not forget, as India, we have the small bit of vagary of the monsoon as well. So yes, I believe this is the best case. I'm equally convinced we are definitely going to come out of it. Uh, it was a Y2K of 2000, 2001. And even that was a troika. We were reeling under sanctions imposed by the US post the nuclear tests carried out by India. And then we had the Y2K and then the liquidity challenges. And we came out of it thereafter. And soon after, we had the 2007-8 scenario, post which we had 9/11. And we came out stronger post that as well. So I'm pretty convinced after each of these phase, once in a decade, we have 4 to 6 quarters of slowish and sluggishness, and the fundamentals don't change. On that note, Sanjay, we can get on with the core agenda, and then we can get some Q&A done. And happy to address some of these as a part of the Q&A as well. But I want everybody to agree that, yeah, we are in a situation we have to act differently, but equally is that things will be back and we should be positively looking forward to it.
Thank you, Ashish. Sumel, just a quick question. We've got quite a few participants here. Would you know what is the mix between consumer of the entrepreneurs? What's the mix between, say, business to business and consumer? Just broadly, one question. And secondly, is everybody from Mumbai and Greater Mumbai? Are there people who have dialed in from outside also the area?
I believe major chunk is from Mumbai. If at all they are from outside the city, that'll be hardly 10%. And as to answering your first question, I believe it will be difficult to determine who are B2B and B2C as of now.
Okay. I wanted to say one positive thing that I saw some women entrepreneurs and some ladies. So that's a fantastic thing. I think we need more of that. So it's really nice to see. And thanks to the video, we could catch a glimpse of a few. So Ashish, thanks for that lead in. We're going to keep this quite interactive. I'll just start off with some, I'm going back to the original flow, but we'll keep it quite dynamic. What I was going to talk about was more go-to-market and sales and the organizational side. And then Ashish will, I think, obviously finance is the lifeblood. Finance is always the lifeblood. And today it's going to be front and center, right? So I'll come back to Ashish. So I'm just going to, I just made some written talking points and I'm just going to just read through them and then we'll stop and question. So, if we did a survey of our enterprise customers, right? Those of you are maybe, I don't know if you're selling to the US or even selling in India. It could be a traditional enterprise SaaS, or it could be everything from agri-tech to fintech. I think we're going to see stretching out of buying procurement cycles. We might see a consolidation of vendors and software providers. I think from a startup point of view, we definitely plan for long sales cycles, right, and account closures. So what that actually means is that, we separate a lot as startups, as CEOs, as founders between account development, account management, account and relationship management versus new business development. And I think never before will account management be more important, right? That is like hold on to your existing customers. So I think new business development, like just imagine if you're pitching to somebody, to a Reliance or a Mahindra or Tata, the fact that the executives themselves are maybe working from home, I think retain your, reduce the churn and really hold on to your existing customers, right? So for whatever field you are. So I think that will be unanimous. I'm sure a lot of you will agree with that. So that was more, I think if there was a takeaway, I would say, definitely account management, retention, and reducing churn is very important. The second point is about inside sales. If you look at Freshworks, right, we've got some great examples that have put India on the map. I think this is actually a very interesting time, both in terms of, I think, new tools will come up. So for all of you entrepreneurs that are out there that are developing, thinking of tools and platforms that will help both individuals and businesses navigate the current crisis, I think inside sales is never going to be as important as today, right? Because you can mine data, you can find out who the profitable customers are, lead generation tools, and I think actually even as VCs, as investors, we might see interesting opportunities to partner and to invest in. Again, maintaining existing accounts, reducing customer user churn, right? So that's a point. related point, I think it's actually, I mean, Ashish addressed it well. This, in one sense, is a downturn, right? Whether you call it it's a virus crisis in that sense. It's actually a great time to hunker down and build product. So I know there are lots of, I know a lot of us spending time on Twitter. I think we'll see actually stories of similar downturns where great new products were developed in a downturn, right? When everybody's hunkering down and sort of worried, that's, new customer behaviors come to the fore. So I'd say if you all have enough runway, I would, cut costs a bit and really build, maybe tweak the product, build a new product. Um, the fact is that new opportunities will emerge because user behavior changes. Even within enterprises, you might be surprised. You look at CRM, there is deskless, there is sales reps, inside sales, field sales reps. There could be new tools for different types of enterprise CRM. So I think it's a great time to hunker down and try different strategies to build product. I would also say that focusing a bit more as much on marketing as versus sales. So if you look at those of you who are in cross-border businesses, clearly like if if you all have, some of you all have connections to the Bay Area, San Francisco itself is under lockdown, right? So even if you're in the city, enterprises or other customers are not taking meetings. So actually, I think positioning and evangelizing and educating and developing a marketing message is very, very important today on how you can stand out from the others versus just selling. And as far as selling is concerned, I think it would be quite interesting to look at strategic alliances and partnerships rather than sinking a lot of money into direct sales costs, right? Because if your sales guy is out in front and nobody's meeting him, you're, in one sense, that's money wasted. So I think it would be quite interesting to look at low or no bases, high variables, or even strategic partnerships and alliances, because in one sense everybody's hurting, right? So everybody's quite willing to partner and help and share. So I think that's human behavior. I'm Before I get to organization, I think I wanted to stop there and maybe just around go to market and sales and questions that Ashish had. Maybe we can take a few questions. We can start off with maybe any reactions or inputs to what Ashish started off with, and then we can move to the others later. If anybody wants to start.
I think we should continue because I can see that not many questions,
Okay, fine.
on the group chat.
So the second aspect. Okay, Ashish, if you can just monitor that, and then I'll do it when you're.
Yeah, I'm there.
Super. So just to summarize, I would say that I think account management and reducing customer churn and hold on to your existing customers is most important. Now, if you look at the organizational side, I'll go into hiring also a bit. I think generally I would err on the side of caution as far as as far as hiring is concerned. I would say go a little slow. You don't want to make hiring decisions in a rush now for multiple reasons. And I'd also say, for entrepreneurs on the call, we're all going through this sort of personal catharsis also, right? Because of what's happening. So it's a good idea to actually think about what the founders are good at and hunker down in those areas. In the sense, divvy up even more, right? If somebody's like finances is good, like what Ashish is talking about is so important, I would focus a lot on that, right? So maybe one of the founders just focuses on cash flow management. It's going to be super important, right? Somebody else looks at marketing versus, let's say, if you were starting up, everybody was doing everything. I think a clear delineation of roles becomes even more important now. I will say that if you have to make, if you've got to make tough hiring decisions, I would say one size does not fit all. And what I mean by that is that, don't cut across the board, right? Think of the top performers. Some of you may have small teams, some of you may just be, 2-3 people. But if you have larger teams, I would say that think of the top performers, keep them close. This situation is going to improve, and then you can hire. Versus saying, I'm going to cut everybody's salaries because that's unfair to your top performers. So I'm saying I was using the term one size does not fit all. And uh, I think sales and customer acquisition is going to become stretched and expensive. So again, what I would say there is that focus on existing customers. Really think about, we all use Zoom free, but let's say if you have multiple tools, cut those tools, consolidate that. I think generally consolidation versus spreading out will happen. And again, I think for direct sales, cut down the direct sales force maybe to the top performers, and then look at inside sales, lead generation, and strategic alliances and partnerships. So that's as far as hiring was concerned. Um, I think as far as hiring is concerned, I'll tell you from our perspective, VCs, right? I think going slow is going to become the norm. So whether it's, you know, if you saw a lot of investment activity from the VC side, that's going to become a little smaller. Not to say that we will not see interesting opportunities. I think we'll see some of the most interesting opportunities will come up in a downturn. But generally, I think tread carefully. If you're planning to hire maybe 10, 5 resources, maybe hire 2, see how that goes, and then take it from there. So yeah, I'll stop there. I think I've covered go-to-market and organization. Ashish, what we could do is, I know you started, maybe you can go back to it and then we could take questions.
So there was a question for you, as you can see on the group chat. Uh, so Samir wanted to just know from you about the opportunities for consumer businesses as the world is spending more time at home. How would you look at it? And do we see a slowdown even in these kind of companies, according to you? So it was a question he meant to address to you.
That's a great question, and Ashish, all these questions are addressed to both of us. So I'll start with this, but this is very interesting. I'm sure all of you have heard of our companies, Blume companies like Milk Basket, like Dunzo, and others. And very interestingly, and I'm sharing this openly. You've got all your coffee chains like Blue Toka and Third Wave, and somebody just wrote to me asking if you can connect them up. That's a great example, right? Because if you're basically getting coffee Dunzo at home, that's exactly addresses to your point. All of us are spending time at home. We're spending time on Zoom, and so I think yes, I think there will be opportunities in terms of uh, different delivery modes for different products. Um, I don't know if this answers the question, but also you're seeing certain sectors like edtech are going to do some very interesting strategies online, right? Whether it's free online courses, and you're already seeing that from our own Unacademy and Topper. So I think we're going to see that. Ashish, maybe you can talk about Turtlement also. I'll turn it over to you.
No, sure. So on the particular question about, I just see somebody else also has put out as to will this be a permanent shift to maybe e-commerce, or will this be a passing phase? So let me break this up into two parts. Why every phase, every scenario that you are had witnessed, whether it has been a very strong momentum of funds flowing into startups, or whether it has been some degree of focus around unit economics, and therefore the related pinching that happened in 2016-17. All of these are cycles, and I don't think it's possible for me to imagine at this juncture whether this will be a good trigger point for things to straight away move to e-commerce. And here are my reasons. While the market is huge, iteration of physical commerce, the reach of physical commerce continues to be extremely high. There are fundamental factors in India which are somewhat different from a lot of other countries, and that includes China as well as the US. Uh, India is one of those places where you will see a healthy mix of offline and online commerce and their congruence. Partly the reason we have had a fair bit of companies which focus on actually the offline to online and the overall strategy, which is a more integrated strategy. So I don't think this is going to be the trigger point where suddenly everything moves. There will be a healthy mix. per se the penetration of e-commerce is slow. So where there were some habit changing triggers required, this might just trigger that a little more, will hasten those a bit for sure. We've seen in some of the portfolio companies, like Sanjay was mentioning, things uptick a little bit by virtue of the need. Even Zoom video calls, conferences and webinars have been there for a while. But still, we were going to, 3 weeks ago, we discussed and agreed to have this particular conference at a physical location, and we have shifted to Zoom. And how many of you would say that that's a reality? That's a reality going forward permanently? I don't think so. And I think in terms of edtech startups with online content, something that we just have a question posted. In terms of opinion, I think no, we have been, I would say, fairly weighted on that, overweight, if I can use that word. We believe strongly enough, and we have an academy which is there in that space, and we have a couple of more going. At the same time, we have felt always that as I said earlier also, there will be a balance. But yeah, we would see some of those doing well and growing up. Education, whether it is the early segment or the beyond the K-12 and online coaching, test prep, all of those. Broadly, my conviction and Blume's view is that those will continue to bloom, if I can say that. So that's broadly my thoughts on the edtech. We continue to see questions. Sanjay, you want to continue with the flow, and then I'll keep coming back to the.
Yeah, I'll just add, I'm just looking at the questions. It's great, guys and gals, to get this level of interest. If you look at EdTech, I think there were some irreversible trends that started regardless of the situation, right? If you look at the online move, I mean, Unacademy startup is online only, it has nothing to do with this, right? Or like a topper. So I think the fact is that learning itself is going through a fundamental shift and a fundamental change. Now, this just exacerbates that. It basically accelerates and amplifies the opportunity even more. So I think EdTech is perfectly prime. And also within EdTech, you have, it's not one size fits all, right? It is K to 12, then it's high school, it's colleges. I mean, we have leverage edu in our portfolio. So I think EdTech is very well primed. I see some questions on this could be an interesting opportunity for this. Then there is a question around, I'm just looking at this as around B2B.
I'll take the next one while you look at the
question. Go ahead.
So there's one question from Mayank, and he's asking, will VCs who have raised money, and maybe if it's targeted to us because we just finished raising our fund and announced it, from that perspective as well, it's a fair question. Do you think that VCs who have raised money will continue to invest business as usual, or will there be a pause? So, mind there are two ways to look at it. One is that things have changed very quickly, and some of the changes that are happening could have a very long time bearing if things don't get in control. So what I'm trying to lead everyone to is believing that if things everybody's waiting for getting a pulse on how long this is going to last. If we have some kind of control on the situation and we realize the fact that it will get to normalcy next quarter or a quarter and a half, as I mentioned earlier, things will get back to a similar pace in that zone. However, if people discover that in 2 weeks from now, we are talking about further lockdowns or deeper measures to control the situation, then we're definitely not going to find it easy for people to cut checks. And the reason is very simple. If we are at a point where you are seeing that consumer spending will get hit because of financial related measures, enterprises are going to go slow. While people have announced work from homes, it is going for enterprise businesses, enterprise centric businesses, new decisions might still be slowed down a bit. So when there is going to be a bit of scenario where people are going to take a pause and wait and watch, it'll impact everybody. And the other way to look at it is, it will be top down, where when you see stress in companies at large businesses, the large funds will start focusing on making sure that where they've allocated money, they can stabilize those. Some of those companies might come back and say, look, it is purely the market. We were doing well. We need some more money by way of a bridge round. You please sail us through for the next maybe 3 months or 6 months. So the large funds might have to focus there. And that means that at growth stage, which is Series B, C, it will put a stop where they will have to fend for themselves and look out for their existing portfolio, which in turn will put pressure on the bottom of the chain for early stage players, which includes some of us and our peers. So there is a fair bit of top-down effect, the second way to look at it. But I do feel that even if you disregard the top-down effect as once in a season effect, the bottom-up factors are such that people will have to wait and watch. And only once you have a pulse on where this is likely to end, will it get to people deciding whether we should go business as usual or we should take a pause. So this is broadly my take on this particular point. And in terms of remote work, Vijay's question on will be shift to work from home. Look, I think that shift is in some sense in the startup world has already happened. Banks are open, insurance companies are open, stock markets are open, and transportation business are open. But otherwise, in the startup world, work from home, part work from home has already happened in whether we like it or no. And that is going to be the case on people working, where it requires ops talent, where it requires sales talent to be on the road. People are still taking a call on whether they should divide the teams or how they should manage some of these things. But in general, for people who can work from home with little or no productivity loss, people have shifted and people have adjusted to the fact that we are going to have a little loss of productivity. There are people in our portfolio, when they come to us and they check what should we do about salaries to people, there might be some work that we just cannot achieve. There's some loss of productivity where things could get delayed a bit just because we're working from home for various reasons. And where we have funded and we know the fact that this is a situation beyond control, we are saying, let's make sure we don't know whether this is permanent or temporary. Let's go with it for at least another about 30 to 45 days and not get into you opportunistically salaries and all that. And once we have clarity on where things are headed in another 2 to 4 weeks, we can take long-term calls, but no opportunistic behavior. And VCs who have gone and cut term sheets, I would expect that people would honor their word. Where people have gone and waiting for monies to be wired, I'm hoping and convinced that people will honor their word. But either ways, there might be some impact for sure. How much? I think we have to wait for another fortnight or two before we get to that.
Sure. So, Ashish, while I go, there was one question around the smart savings platform. And then the latest one where you can think about this consultancy provider, the business generation. I'll just take some of the others. So I was just going back, I think there was a question about remote work and then also something around B2B, right? About horizontal or vertical SaaS. I think if you think about remote work, we have a company called TapChief. There's another company, another investment we have called Frap. Like EdTech going online, these are already happening, right? I think this is going to push it even more. If you look at, look at Elance, right? That was started years ago. That was the first sort of pioneer in this. And, you've got Upgrad and then lots of Valley-based companies also going to remote work. This will obviously, will benefit from this boon for the next couple of months. But everything has to, remember, let's also be clear that everything has to have a very viable business model, because again, enterprises are again going to clamp down a bit in this, the procurement and the sales cycle, decision cycles are going to take longer. So it has to be obviously very compelling. But there's no doubt if you go to Bangalore, if you go to a Third Wave Coffee, or if you go to Blue Tokai or Starbucks, you already see lots of freelancers, right? I think there may be a move to maybe subcontracting, all of that. There is definitely a parallel economy. So future of work. I mean, your story just had a conference in Bangalore about 2 weekends ago, just before this whole scare started. So future of work, we like to say the future of work is already in the present, right? It's not the future, it's already here to stay. So it's real, it's not the future. In terms of B2B, see, I think, the right way is not to look at labels and put labels on it. I know if you look at some of the articles, it says, it was all about horizontal B2B and now it's vertical. You've got Zenoti for salons and spas, and then you have other vertical SaaS. It all depends on the enterprise customer problem, how large the total addressable market size, the TAM is, and you take it from there. Uh, but interestingly, I think, if you think about where SMBs, if you think about, you have consumer, you have enterprise, you have SMBs. SMBs are going to hurt even more, right? Because they'll be short of staff. They will, it's too expensive for them to go and buy SAP or Oracle. So there is definitely a pain point to, look at some verticals, look at SMBs. Like you've got Hotel Logics that looks at, the hospitality space from our portfolio. You've got Rate Gain, which is not one of our companies that looks at that. So definitely, I think, if you can service SMBs, much like what Khata Book is doing, on that side, there will definitely be opportunities in that space. Um, so I'll take this last question is interesting, and Ashish can add. I think this is a great question. Do you have any tips on how to maximize your team's productivity during the work for home period? I will say this topic is so new that I would love to get a poll from all the 100 of you on this call, right? This is so new. We're all learning at the same time. One thing we're seeing is that, we implemented a optional work from home policy starting this week, right? For about we have 3 offices in Bangalore, Delhi, and Bombay. I think one thing that people are missing is they're missing the camaraderie. We're rotating. Uh, there is sometimes maybe a little drop of productivity because people are working from home, but obviously people are upbeat because they feel safer. I think again tools come in. So I think one of our the younger folks in our team was quite interesting. Came up with an interesting hack, which was you can do like a morning stand-up meeting, right? A morning, afternoon, and evening startup meeting over coffee, where you basically go around and talk about what you did yesterday, what you're going to do today, what you will do tomorrow, interesting ideas that other people are seeing. Because I think, how do you maintain the balance of safety yet not lose that spirit of community? So I know there are lots of blogs. Ashish, I know you've been spending more time in office since we started, so maybe you can share something on this.
I think in terms of synchronization is the key thing, and most of us who are in the tech space uh, would have talent which is staying on their own or in hostels. Uh, so I think from that standpoint, having a suitable infrastructure in place to ensure a successful work from home and business continuity are key things. So we have had, when we started getting feedback and working with some of our portfolio to have successful implementations around work from home, the provision of infrastructure, making sure that people had the requisite tools and even hardware to ensure seamless productivity were the key factors that we started off with. And in terms of the other aspects, I think to each his own. There are some businesses where the team bonds pretty strongly, and that's how they're used to work. For those type of businesses, it is important that you have once in a day sync ups where everybody comes on the Zoom call. I know that for large teams which are like beyond 9, 10, 12 people, you would have those stamp size pictures on the Zoom call as well if you're 20, 30 people. So that doesn't fully quite serve the purpose. And which is where at least in our setting, what we came about was that let the office operate 50-50 with no two teams overlapping each other. So let everybody operate an alternative day cycle where people will divide into 2 groups. If this needs to be made into a smaller group, we will do that as well. But no common persons across those 2 groups, so that at least we will have some degree of connectivity. And where we are seeing that people are completely cool, just a sync up between the managers and the teams once in a day would be good enough. And that this is broadly some of those basics. For most of us, it is less than 2 weeks old. For us, we're implementing it since this week. So we're also figuring out. We have tried to put out as much as we can to our founders in public domain as well. I will, on that note, what I will do is also jump on to a couple of other questions that have come. There have been a couple of questions which went up in the scroll, which I will just take, and that is how do we typically look at early stage opportunities? So when we're talking about investing in startups, seed rounds, and pre-series A businesses, how are we exactly going about? What are the factors that are at the top of our priority? So I think there are two factors which are dominating factors, which are very fundamental. The first and foremost is, of course, all of you, the founder at the center of the decision making. So if we have a great set of team that we have cracking a problem, I think that's a good way to start. And within the founder also, it's just not about one founder. It is about how a team has come along. So the key founder has another co-founder or maybe two co-founders, and is there a team around it? Uh, each fund would have a different life cycle and a different mandate that it has taken to invest. But for most funds, philosophically things would be the same, which is when you're investing in a early stage business, a startup, a tech company, the intention is that you are going with a mindset of about 6, 7, 8 years kind of a timeline, and you want to see that the probability of success of a company may be small, but when it is going to become successful, the outcome should be massive. So no issues if the probability of success is maybe 5%. But the question that a fund tries to answer for itself is that, is this going to be a massive outcome if it is going to become successful? So the way the model will work typically is that if a fund is investing $1 million and taking, let's say, 15% stake or 20%, let's go with 20. The calculation is much more simple. And the point is that at what point would the company be big enough that the fund's exit value is equivalent for at the full value of the fund? What I mean by that is, suppose it's a $50 million fund. One company at least in the fund has to deliver a performance outcome for the fund, which should generate $50 million of exit outcome for the fund alone. And after 4, 5, or 6 rounds of funding, the fund's position is diluted down from 20 that it took initially to, let's say, 10%. And they are looking at an end state outcome of 40 or 50. It needs to reach an enterprise value of 500. So the people will ask these questions around whether the company can become a $500 million company. And nobody has a crystal ball where we can gaze and say, yeah, it will become or it will not. It's not about passing judgments or pronouncements. It is about, can this company has the 2 or 3 critical things required for this type of a business to go from 0 to 100 million. And we know broadly the composition of the team, the ability of the founders to take the story to the market, execution are the key things. We often underestimate execution. That's the second thing that VCs would look at. First, of course, is the team and the uniqueness of the idea. But there are enough cases where quite a few VCs may have invested in an idea where 2 other startups are funded. So uniqueness does not mean that it is one of its kind across the whole market. You are one amongst a kind where you're solving something fundamentally and there is some moat or something fundamentally different in the way you are approaching the market vis-a-vis your competition. And those things can be discussed case to case. But in every sector, you see that there are 4 or 5 companies which are there. Some they may be more, some they may be less. But are there any small differences which are different, making the key differentiating factors? Yeah, then you have basically got the eyes and ears of the VC. And to get a big outcome, you need a big market to go after. So niche plays are going to always be fairly tough to be funded from institutional players. You definitely, there's no dearth of angels who like a particular space and say, even if this company exits at $40 million of exit value, I'm fine. There are enough angels who may want to do that, but institutional investors would want to invest in problems that are very large in scope. You may not necessarily have a large market today, but the visibility that at some point in time over the next 2, 3, 4 years, this will become a massive market. So that's where the vision of the fund becomes super important. And the vision of your partner becomes very critical. So when I say vision of your partner, I mean the investing partner. So these are the 3, 4 things. Just to summarize, the founding team, the co-founders as well as the key members of the team, the uniqueness of the idea. And I say unique, when I say unique, I don't mean solo idea in the whole market. Could be 3 or 4 people in the market are competing, but there has to be something different about the problem you're approaching, some uniqueness in the solution. Third is the execution and the solution. So very often we do get obsessed about the solution. The fun will be to get obsessed about the problem, because the problem evolves and the solution has to keep evolving with the problem. So I think keeping pace with changing market dynamics and the ability of the founding team to keep pace are fundamental. And fourth factor which I mentioned was a large market. So these are the key factors. And then of course, people do care about the fact that whether the space is fundable. If the market may be huge, but fundability is not there. What I mean by that as an example could be that you have 3 players who are cracking a problem, and 4 or 5 key VCs who track that space are all covered by that. And the others don't have a thesis about that space, then there might be a bit of a tricky thing. But that is a factor which will have a very negligible weight. I would not want people to sweat about this problem. The other 4 factors that I mentioned are far more critical to focus and lose sleep over. Sanjay, would you like to add on this, or we can jump?
Somil, before that, thanks for that. Thanks for the long view. Somil, quick question: is it possible to a technical question increase the size of this chat box?
Yeah, I have been getting that question. I guess we won't be able to do that from our end. Maybe if your device is permitting that, then you can go ahead. We have tried from our end to do that.
Okay, no problems. So I think Ashish covered a couple of questions. There was one question here said that in this environment, what's the difference in how investors evaluate investments, right? I mean, how do we evaluate an entrepreneur? I think Ashish covered it. I mean, typically if you hear, so there are 2 questions. I think there was one question about, isn't there a smaller fund can make investments which a larger fund cannot at the same valuation? Yeah, that's a quite an intelligent question from a existing or a future fund manager here. Somebody on this chat. So I'll just take them one by one. I think the fundamentals are pretty much the same, right? I mean, it's the strength of the team, the size of the market of the problem that they're solving, and then what is unique about the solution. I think one thing which will stand out even more is startups are already a very long-term game, right? We know. I don't know how many of you understand our business, right? To actually take money from us, first you've got to understand our business and our customers. Typically, most funds are 10 to 12-year funds. As it is such a long-term game. Then you throw on a situation like this, which throws even us out of whack, right? So what that means is that one thing that will stand out even more is the endurance of the founder and the founding team and the people. A lot of you all may be aware of SaaStr. I look a little more at enterprise B2B global sales. So Jason Lemkin, who's the guy behind SaaStr, obviously is quite disappointed because SaaStr itself was cancelled. And one of the sayings there is, for those of you in B2B, is that one of the biggest problems of B2B is not sales and revenues, but it's a tired CEO, right? Because the sales cycles are so long, the Infosys and Wipro have such large sales teams that even if they churn, it's okay. The job of actually the senior managers is to manage the sales people to make sure they sell. So endurance, right? You use the Hindi word lambi race ka goda, is going to become even more important because this is going to become even more of a long-term game, right? Which is why it's called early stage, because the gestation is so long. So I will just say that what that means for entrepreneurs is think very creatively, but think also very carefully about becoming an entrepreneur, about doing what you do. I mean, I'll give you a very practical example. Everybody, slight tangent, but it's true. Everyone feels that, oh, to be a successful entrepreneur, you have to raise VC funding. Many of you know Zoho, right? Sridhar Vembu has not raised any capital at all. Girish started at Zoho, then started from Zoho, went to Freshworks. Atlassian, which is an Australian company, has become very successful. MailChimp has never raised capital. So I think it's a very practical question to ask everyone that, hey, do I really want to raise outside money? If I am at this time, should I, do a small angel round? Should I bootstrap and maybe raise later? So I think the point I wanted to uh, just make is that this is going to be a very, very long-term marriage, given this, because right from the macro experts on Wall Street, people don't know how long this is going to last. So the endurance aspect, I would say, for founders will come out even more. There was a question around. Let me just see. Ashish, anything that stood out that we should take?
No, you continue with the flow.
Okay. Ashish, after this take, there was something around the smart savings platform. So I'm just looking at this Zero. Yeah, so I think it's going to be very interesting. You're going to see truly disruptive models. Like if you look at Zero, look at Small Case, right, which is our portfolio company. This is the so I'll give you a trend. I mean, we are not in the business of predicting trends, right? You always want to back entrepreneurs who are solving a market problem, not following a VC that's predicting trends. But one of the things that I think will change and increase is going to be more automation and more robotic, RPA, robotic process automation, or just automation, or more, I think, streamlining of outdated processes, right? I'll give you an example. If you look at the airline industry, airlines are already getting hammered. The tourism and travel industry, right? So conversational voice AI, anything that basically helps improve the customer service, given that some of these industries are going to be battered, is going to stand out a little more, right? Not that all of people should rush into that, but just think about the kinds of industries that are going to get impacted, and parts of the supply chain that they're going to get impacted, and think about going after that, because those could be global. I mean, the beauty of I'll say this: the beauty of India. I mean, I think, look at this call, right? There are more than 50 people. I think we will always be the talent engine of the world. I think that's our strongest, right? Yes, we send the Sundars and Satyas to the US so they become CEOs of those global companies. But the fact is that we will always be the talent hub. And I think this is a time when you can build some great companies for the world, right? Because whatever we're facing is a global. If this was TiE Singapore, or this TiE Boston, or TiE New York, I guarantee you will be discussing exactly the same things, right? This is nothing to worry about in that sense. I said, Ashish, do you want to take the
Yeah, there was
around smart savings?
a question. There was a question which asked about whether it would be a good time to introduce a smart savings platform given the challenges outside and various other factors. So I think I just had a more fundamental point to make. I think, I think it's a viable business to be created for sure. And whether it is small micro savings or it is larger sectors, we have exposure there as well. And we believe fundamentally that things like uh, fintech at the bottom of the pyramid, coupled with agri-tech and the hybrid of those markets, have a strong future. And independently also, both fintech and agri have a future on their own. What I wanted to make as a macro point is that businesses should be incubated on more fundamental factors and undercurrents. Uh, Building a business for a scenario like this may not be the best of ideas, because like a good momentum, even adverse scenarios or downturn would convert and change. So per se, on the face of it itself, there's a merit in micro savings as a market. So I fundamentally do endorse that thinking. But on a macro level, just to summarize, don't build businesses for a certain phase, or don't build businesses to say that I think if I do well, something will acquire me. The responsibility for exit, as much as we investors make founders sign agreements for exit and have you commit, it's a joint responsibility. So it may not be the best of ideas to simply build a company so that LinkedIn would acquire it, or so that X business could acquire it. It businesses should have fundamental factors, should have profitability goals in mind, should have scale goals in mind. And when I say scale, I don't necessarily mean try and build for unicorn. Valuations are not where I'm leading everybody on this group to. Those are numbers. While we all aspire for it, and that is how we get assessed, founders eventually get awarded on the basis of building fundamentally strong businesses. So if the areas where you all are building, it's perfect to build lifestyle businesses and not raise money from VCs. That's perfectly fine, but not a best of ideas to raise money for the sake of it.
Sure. Sumel, do you want to direct us to any questions we have not covered? Or Rahul?
Sure, we had a question from this gentleman, Mr. Romil. He's been pretty keen to ask you that question. Let me just get direct to that question right now. Rahul will post that question on the group right now.
So there was a question for Sanjay on AI-based fintech businesses, uh, which I think Vijay meant to ask. I'll take that, and of course Sanjay can add. Uh, so I think, as I mentioned earlier, briefly, fintech per se is a strong enough driver, but fintech is also big enough a sector to now get into smaller layers, and what part of fintech you are looking to go after. So when you are looking at fintech, it's almost like a matrix. On one hand, you have various categories of people basis where they are in the hierarchy. Either it's a bottom of the pyramid, or it's a mid market, mid bulge market, or it's the top of the pyramid. And then you have various services as well, and that is more on the B2C side. And there's a bunch of opportunities on the B2B side which have not been dealt with in a very significant way, whether it is treasury solutions for banks, whether it's cloud solutions for insurance companies. We have seen people trying to disintermediate when it comes to fintech. The attempt for a lot of players is to directly connect to the consumer from a service. Well, while that is something that is a good idea, but I also feel that uh, people in India, when it comes to financial services, it is not going to be disintermediated very easily. Over the next 15 to 20 years, I still continue to believe that whether it is products like insurance, savings platforms, etc., they would be a combination of tech plus human will work, whether it's a sales process or it's a services process. For AI-based interventions there. However, the scope is best when it is not like jargons. When you say blockchains, AI, etc., there has to be true learning capabilities and the ability of the system to service the customer and create meaningful savings in the value chain. Otherwise, when we see some of these pitches which aggregate relationships with banks and are trying to create neobank like structures, and the end state monetization is only from the lending. Well, lending per se has a great scope, but at the end of the day, it all boils down to what exactly in the value chain are you saving for the institutions that are working with you, or what is the value you're creating for the customer. to sum up the answer, yes, fintech, AI-based fintech, blockchain-based stuff does have scope for sure, provided there is real value add and not disintermediation for the heck of it.
Yeah, Ashish, that's a great point. I wanted to make an important point that Ashish also highlighted earlier. Maybe I made it in a different way. See, we are long-term investors. We are not momentum investors, right? We don't invest with highs and lows. I mean, this is a 10-year, 12-year cycle at most extendable. So one of the interesting things, if you look at future of work or look at a couple of trends, right? The move for edtech for students to learn online. Look at the future of work. If you look at robotic process automation, all of these trends started way before and has nothing to do with the virus situation, right? So when I was suggesting, we're not necessarily saying, okay, listen, look at what's going to happen in the next 3 to 6 months and try and build a platform that's going to make some money, right? Not saying that at all. All it's doing is that there's certain irreversible trends that have started that will either slow or hasten given the situation, right? So I think it's very important to remember that and realize that we are not in the business of funding sort of spikes or momentum, right? Because we talked about endurance. We're talking about building long-lasting companies that are going to go public over 10, 20 years. The Make My Trips. I think a best example, one of the best homegrown examples is Sanjay and InfoEdge, right? I mean, there's a reason he was awarded the Padma Shri because he's been doing this for so long. Successful serial entrepreneur, investor, and over a long time, right? I mean, again, using the marathon analogy, that's one. The second is, I think we have to also be careful of using buzzwords, right? I mean, think about it. The AI at the end is just a tool. Ashish was talking, whether it's smart savings, whether it's neo banking, customer doesn't care what tool you use, right? The customer, whether it's a user or enterprise, is not going to say, okay, no boss is going to tell his subordinate and say, go and buy the best AI tool. They don't say, "Achha hai, I'll use it," right? You're basically going to say that which gives you the best business benefit. Given that, I think if you look at tech, right? I think which is why fintech is taking off, because it is potentially disruptive, right? I mean, once you have people transacting on a platform, you can lend to them, you can sell to them. There are so many interesting things that happen. So I think the larger point that I wanted to say is that we have to steer clear of buzzwords and jargon that, I am an AI for fintech platform. People ask me, tell me what do you exactly do and why are you better than the other solutions and the other alternatives that we have. So I am looking at something about coffee getting delivered by Dunzo. Will people accept the delivery in the situation where now hygiene is very important? Any suggestion on delivery where human intervention is a great question. So one of our colleagues actually, it's interesting. Dunzo has come up with some contactless delivery. I don't know the details of that, but I think there's going to be innovation even around this, right? Because what one doesn't realize is the person who delivers it may be carrying something, right? Even though you're not going to the restaurant yourself. Ashish, I don't know if you can also add to this, but I think there will be innovation on this front also, right? And if we can get our favorite products delivered home, there will be innovation and different levels of hygiene and at that level. Ashish, you want to add to that?
No, I think you've addressed it. I'll use the opportunity to, because I am seeing a fair number of questions coming up. So couple of more questions I'll address. And also, I think if it is a specific company-centric case, I'm skipping only because those may not be very relevant for everybody. But if the organizing team feels more than happy to take some of those as well. So there's one question at a generic sector level. It talks about the global legal market, and it talks about when it comes to legal tech investments, we have seen some resistance from the VCs, and it's basically trying to ask what is our take on it. So I look at that space, not legal tech when I say financial tech, regulatory tech, compliance tech, etc., are the verticals that I look at a little more closely. and we'll try and address this. And more than happy if there are specific counterpoints to be addressed. Because this is the third time I'm answering this almost in the last 24 hours. I did one last evening, one this morning, and I'm defending here. I don't think it's about people saying no to. It's more about the principles that I tried to put out earlier. So when we talk about a small fund wanting to invest, they would expect that this has to become a large market. It has to become a big business outcome for us. And as I mentioned earlier, and somebody even followed up with a question that if a small fund will invest in smaller outcomes and big fund will only go for bigger outcomes, no, I don't think so. Even a small fund will say that I want only mega outcomes, but they can do well even if those mega outcomes on the path somewhere end up becoming small outcomes. So that's okay for them. But for us, if a business is successful and good, we need to see it scale to a large outcome. So far as compliance tech, legal tech are concerned, there are 2 or 3 observations. Over the last 20 years, I have seen quite a few softwares solve and products. These are not, these are SaaS services, these are product-based services. Besides some of them, with exceptions, and Tally I would count as an exception on that front, most of them have gone on to plateau at some level. So they do about 2-3 crores of MRRs, or maybe 20-30 crores of ARRs, and they become more like tools. What then happens is you have to figure out how you will deepen your engagement with the customer besides just helping him with tax filings, or besides just some legal, helping him study some case law on the legal front. There have been global instances where people have tried to fund companies, VCs have funded companies deeply on the legal tech side. There have been law firms which have taken the tech route and to automate contracts and all that. But somehow I think we are getting some of those to one of the 2 extremes. Either some of them are taking it purely to a product thing and trying to overemphasize on AI and related stuff to make it fully automated and SaaS solution types, or people are saying offline is the only way to go. My personal belief is that there's a hybrid for the next 20 years that will work much better. So if a law firm is becoming a tech business, I don't think it makes sense for it to just switch off everything and just optimize on becoming a pure play tech firm. The fact that it's a physical delivery system there, offline, it should be combined, and those should become hybrid businesses. In services, particularly legal, compliance, regulatory, I think the best businesses will be those which have a full stack model. And that's our observation as a VC as well, that in some of the businesses, because the market size in India on niche verticals may be too small, and it takes much longer time for businesses to move out of one silo and capture other side of the market as well. It is much easier to be a full stack delivery model where you have tech on the front and you have some degree of fulfillment that happens on the back end as well. It's not compulsory for VCs to just say that shows businesses which will take over human jobs. No. Today, Facebook has close to 50,000 employees on full time on the payroll, and they have a large number of people outside on contract. When we talk about Flipkart, etc., we look at them as tech businesses, but look at the employment they create. So it's perfectly fine for hybrid business models to emanate, but we do feel that full stack business models is the way to go for the foreseeable future. Things may change over the next decade, and we'll be happy to change our views with that scenario. But for now, Rust, so far as we are concerned, is more full stack.
Sure. Ashish, it's great. I wanted to address, there were 2 questions that came about around founders. There's one, by the way, somebody's talking about coffee. We could all use a coffee right now. There's one question about founders, about what's your take on single founder companies? Do you consider them for funding? A startup with strong founding team and able founder, but no co-founder, how the VCs evaluate it? So, not to give a one-size-fits-all answer, but again, I'll come back to that this is one of the most lonely journeys. In fact, if you think about even a Fortune 500 company, the CEO is a lonely person at the top, right? You're talking about a company with $100 billion dollars of revenues. The CEO, of course, there's a public company CEO. If he doesn't perform, he can be ousted. So it is lonely at the top. And one of the reasons a lot of VCs, including us, will look at it a little differently is that you need a sounding board, right? I mean, look at the times that in one sense, I will say, and I will say this credit to Ty and to all of us, I think I can say each of us are each other's sounding board right now as we're speaking, right? I'm looking at you and it's amazing. I took a screen grab, I sent an image with the team and I said, it's wonderful. We're all sitting at home and there are 75 people joining Sanjay and me on a call and everybody's clapping and saying, can we get on that call? Everybody wants to be on this call, right? Because in a sense, we are each other's sounding boards. And because the CEO journey is lonely, let's say you have a brilliant idea, right? I'm looking at, let's say Vijay Jagori, right? Vijay, I'm looking at you. And let's say you have a brilliant idea and you don't have a co-founder. Who do you test it with, right? You go to your family is going to say, fantastic idea. Your best friend will say it's a useless idea. But can you get somebody who's vested? So actually, more than convincing an initial customer or the second level of employees is the first person you can convince to also leave their job, not take up a job and join you, right? Now, so I think there should be at least one co-founder. Now, some people say it should be, there be three or four. I think two is great to start with because you need somebody to challenge you, need somebody to push you, right? That's important. Okay, second nuance, this is very, very important. The two co-founders do not have to be equal. Okay, so for example, if you look at Sachin and Binny, they started, both finished from the same hostel in IIT Delhi, went and worked for Amazon, came and joined. Maybe they're equal, that's fine. But a lot of people feel that, oh, you have to be exactly equal. It doesn't have to be so. It could be, Mayank, it could be your idea, and then somehow two other co-founders come and join you. That's fine. The equity split does not have to be the same. It has to be equitable. It does not have to be equal. It can be equal, but doesn't have to be. If you look at let's face it, look at most of the companies out there, right? I can bet you that half of y'all may not know Bhavish Agarwal's co-founder at Ola, right? Everybody knows Bhavish. Everybody knows VSS at Paytm. But the whole idea is that it's a team. So I think it's important to go and find a co-founder, and it is actually as important as it is a marriage, right? So not to say that we wouldn't back it, and there can always be one main founder, but there should be a co-founder, and also importantly that I think the founder has to be willing to share that equity, right? Because again, it's a lonely journey. What is the startup? You're going after a brilliant idea. You're going to say, I'm going to go out and change the world. And then I'm going to recruit great people to join me in this mission, right? If you're going to do it yourself, how are you going to do that? And what are you raising the capital for if you're not going to hire other good people, right? That's what we would ask. So one of the biggest successes is the ability of the person to go and convince customers, employees, and people to join them in that mission, right? Which is why having a co-founder is important. So let me see, Ashish. Sumal, can I turn it back to you, Rahul, if you want to direct us to some of the questions we've not covered, which have not been covered at all, which are a little different? Okay, deep tech ventures, I'll take that. I want to see if there's a question for Ashish before that.
Yeah. Meanwhile, even Rahul will be going through the questions. If there is any, he'll be posting it on the chat itself.
I can take the deep tech one. I can take the deep tech one while you're talking.
Sure.
How do you consider and evaluate deep tech ventures that are developing licensable, protectable IP that delivers large business value? So, I think India has come quite a long way. You may have heard of some of these names today. There are deep tech ventures, right? Like our friends like GrowX, Your Nest, Pi Ventures, and of course, Arpit and Anirvan in our own team, we are looking at deep tech very aggressively. We've got Tricog on the medical side. We have Euler Motors, on the EV side. I think again, I was coming back to that point about we've got some great engineering colleges, right from the IITs to the ISCs to the triple ITs, and we're just primed for talent. So I think the potential is huge. The problem has been in the ecosystem after us, right? So if you look at what we do, a lot of the work that we do is basically backing a company, and then who's the next supporter in line, right? Who are you going to take this next? Let's say I back one of you. Who is going to partner with me on your longer term journey if it's going to require? And that depth and maturity of the deep tech ecosystem in India has traditionally not been as strong, which is changing now. So if you look at our Tricog, look at Sigtuple, look at a space tech company like Pixel, our Gray Orange Robotics, right? You may have heard of, they're one of the first companies that we backed. It's changed, but it's got a long way to go because the IP regime in India is not as strong as it should be. It is changing, but I think the government is also helping, industry is helping, NATSCOM is making some great initiatives. We're trying to partner more closely with the robotics labs and the other the CES, right? The Center for Entrepreneurship Learnings out of BITS, that's my alma mater, the IITs, and all great engineering colleges to pick up some of these companies directly from campus. Either have a seed program, scout program, and deep tech is a very important area for us. Along with the Japanese partner, we also set up a program called Buddha, BUDHA, which basically is like a R&D investment program. So I would definitely say for those, maybe older scientists, younger folks who finish from college, if you have an interesting idea, definitely pursue it. These companies can be built for the global. Ashish, while you take the next question, if you want to address the IP licensable parts, that'll be great.
I'll come to that. There's also one question that I see by Romit on valuation of companies. So from a valuation standpoint, there are a few rules of thumb that most VCs will follow at an early stage. At a growth stage, it's very different. I'm not going in that direction. From an early stage point of view, the way things have happened, there's a tendency to do verification between a bottoms up approach and marry that with a top down. So when you talk about the bottoms up, there are a few rules of thumb depending on what traction has been achieved. We have typically focused our energies over the last year and a half, and going forward is going to be businesses where there is a fair bit of traction, which is visible. Not that we're looking at complete strong momentum and $1 million of ARR. No, that's not what necessarily we look at in B2B, or for that matter B2C. But some proof of concept. So if it's a B2B company, would like to see the companies have had at least 2 or possibly maybe at least 1 paying customer who has been paying for the last 2 quarters, and 2 more on the verge of signing, or maybe a little more if possible. At B2C, you want to see the behavior and be able to draw patterns from it. So you want to see the monthly actives, the daily actives, weekly actives, etc., and be able to get inferences on what customers are liking, at what point does demand go up, at what time, what is it that is driving the engagement, which will mean that you will need a few hundreds of weekly users and a few thousands of monthly. Monetization is a little important, but we don't necessarily say that you need to be breaking even or all that. But if the customer is paying full value of his product and has a small tendency to demonstrate repeat behavior, is when typically a fund like ours would have a little more interest. Now, how would we typically value? So when we're talking about it's a broader 3-founder team, things have settled, the founders have raised money earlier, and there is more traction, they get a little more premium. So in a B2B company, it is reasonable that in a normal scenario, if a business is on a trajectory of about $50,000 of monthly revenue run rate as a B2B business, it's not unheard of to expect anywhere between $5 to $10 million of pre-money valuations, depending on what the metrics show. So it's not just about ARRs and MRRs. It's also about the level 2 of the metrics in terms of the quality of the metrics. On a B2C side, there is a fair bit of resonance with the fact that the company will have to raise more money over a period of time, and it is not going to be moving the needle with small rounds of money. So the rounds are little larger, and which in turn results into a bit of a valuation bump up. Per se, I'm not trying to say that they deserve more valuation. The valuations also are a function of the round being raised. A business that goes and raises 3 million when it can absorb only maybe a million or million point five, and if the investor is ready, he might come in and dilute a lot. On the other hand, if the business has scaled very well, okay to just take $1 million of bridge, people more than happy to give a convert note also. So the ranges are a function of what you are trying to raise. For a large dilution of 2 million, for 2 million dilution and 10 million post money, dilution is 20%. But the same founder, same team, if they're diluting, if they're raising 4 million, it's not mandatory for them to dilute 40%. Then the maximum they would dilute is about 30, 35. So it's not a linear thing that you raise double, you dilute double. Because you're de-risking the business and there are more investors coming and pooling in money, you might be able to get a bit more premium. But that is not a premium on the business. That is a function of some risk mitigation, which is leading to a higher valuation. Sorry to bore everybody with a bit of technicality, but since the question was about valuation, I thought I'll just clarify some of these dynamics as well. Once in a while, we do have founders where somebody else is willing to put in money, and we advise them saying that, okay, pad up a little more, but push the valuation a little more so that you don't dilute a lot. It's just a win-win for everyone, because eventually, if the founders have diluted a lot, eventually the larger investors at a later point in time may come back and say, guys, we don't think the founders have enough skin in the game. Sometimes this factor is overplayed, sometimes it's a valid point. So it's a case to case. Sanjay, you like?
No, Ashish, that's very helpful. I'm just going to look at another question. I'm looking at a question from Suraj, which was around, I think there are a couple of questions around approaching VCs, right? Should you have a consultant on board or approach them directly, and then you approach them, you code, if you can't find a reference, you cold email, what are the different strategies? So, this is, the art of this is, as interesting as the science, right? I mean, if you think about it, we're all customers of each other, right? Once we fund founders, they become our customers. When you're pitching the investors, your customer. So if you think of this as I think a couple of things I would say. A lot of people view it as very static, right? I'm going to go and pitch to a VC, and it's one event, it's a pitch event. And I would actually say, think of it as a conversation, right? So for example, you may just say hi, hello to a VC after a panel, and then you have to create a hook, right? How do you be in touch with that person? So references are important, and I'll tell you why they're important. And they're not the only way, but the reason references are important is that the person making a reference is usually quite careful about making that intro, right? So I'll just give an example. Let's say, somebody's nephew or somebody's friend wants a job with the VC, and one of you knows us well. You're going to make sure that that person's really good before you refer them, right? Because if you don't, we're not going to take your call the next time. So people are actually careful about they do that, and that's why the reference calls are important. That's one. But we know it's not always possible, right? I mean, India is a land of plenty. It's a very new industry. So what are other ways to get around it? So cold emails, we have quite a large team. We've got something called pitch at Blume.vc. If that is cold, if anybody has plans, you can send it there because we still don't know each other as yet. One of the interesting ways is just think out of the box, right? I mean, rather than just pitching for funds, think about it. I have a vested interest, Ashish and I have a vested interest in making sure that all our portfolio companies do well, right? As it is. Now, of course, in this environment, they have to survive and thrive. If somebody has a solution for a portfolio company, that's sometimes the best pitch, right, for a VC. So, for example, you say that, hey, listen, You have Dunzo, Milk Basket that are going to be, let's say affected by this aspect in the situation. Or if you have a B2B company that should look at a new tool because sales cycles are going to be longer. So you actually find that if VC's portfolio companies can be users of your product, that is a very interesting way also, right, of making a pitch versus just sending a long email. As far as consultants are concerned, we of course work with bankers, advisors, consultants. The most important is that you have to be, both sides have to be very clear about the role of the consultant, right? That it is to get a meeting. I'll tell you do's and don'ts. I'll tell you what I wouldn't want to see, right? I wouldn't want to see a meeting where, let's say, Aman, let's say, just for example, I'm using a name. You come in and you've got a consultant and you're the CEO, and if it's a 1 hour meeting, I don't want the consultant to talk for 45 minutes, right? I want you to talk. I'm backing you, not the consultant. So good consultants know that, they know when to listen, they do it, and there is a role for them, right? Because all of us are so busy and we have such limited time. It's good to see consultants also have some skin in the game. So, for example, angel investors actually do play a role. Angel investors, because they're vested, of course, they're going to push their best companies to us. But the fact that they have skin in the game, I'm willing to listen because I know that that person has put his money, that he or she has put their money where their mouth is. So, I don't want to dismiss anything. I think we have a large ecosystem for us to all thrive. There's a role for everybody to play in that ecosystem. It just should not be overstated. And ultimately, investors are going to back the founders, right? The consultant or advisor's role is to advise, to open the door, and then step away, right? Very much like, when we back a founder, we also know when to step away, right? We are not running the company for them. So that's what I'll say for that. Ashish, you want to add? I see a lot of
Yeah,
questions
no, I'll take
around
the next one.
pitch deck.
There was a question around pitch decks not being enough and meeting being critical to drive home a few points with the VC. So I think it's a fair point. That said, I think one would need to empathize that for most of our peers in the market, we would be receiving anywhere between 2 to 3,500 inbound, and it becomes a bit challenging to make sure that you will be able to do justice to all of them by meeting them. The other point is that the key thing is that rather than calling people for a meeting, you just have a small 20-minute chat over a Zoom video call rather than wasting the time of the founder. So we have resorted to shortlisting businesses and then reaching out to founders, so we don't have to waste and take a lot of time of theirs. And that has somehow worked a bit for us. But I know that decks don't necessarily take care of in-person meetings. But at the same time, we also have observed that it works best when you have reached out to the VC through somebody who the VC has already invested in with. And when you have been able to reach out through a reference of that nature, VCs trust their founders much more than what people may probably imagine. And if you have reached out to the VC through their founders, more so founders who have managed to scale their businesses, you will definitely be at odds of getting a better hit rate with the meeting for sure, if not the investment. That will be on its own merit. The other quick question that I'll just take is, what about government funds for startup? Well, actually, the government has done its bit by investing indirectly. So funds like ours have been beneficiary of government investing in us, and that is through the SIDBI program. Directly, I have not seen government investing equity money. What we have seen government do is debt. CGSME, CGT-SME schemes, women founder-centric schemes, which are there by government, and these are administered through the nationalized banks. And if you check with your nationalized bank branches, they might be able to tell you. These could be funding rounds of about 50 lakhs to all the way up to 2 crores or so, but on the debt front. When it comes to SIDBI, they had a debt program as well for startups that have bootstrapped and become profitable, or have raised VC money and become profitable. So if and then beyond that, there is not much of intervention from the government. I am ignoring in my answer specific schemes that may have been formed for 5 and 10 and 20 lakh of infusion by way of acceleration. If that is what people are looking at, then there are few organizations like the Bombay Stock Exchange. Possibly, I'm not too sure. Maybe TIE has a collaboration as well, or some of the other organizations which have been part of the Atal Innovation Scheme, who have been giving small time equity infusions. But I'm sure that is not what Suraj meant to ask, Supriya meant to ask. And then I'm just scrolling up to see if I'm not missed. Sanjay, if you have.
Yeah. So while we'll do that, by the way, I see it's almost approaching 6 o'clock, but I think we're good. We're good to go. We're keeping on going. A lot of enthusiasm from this group. So I think Ashish and I are good, at least for now. Maybe we'll do about 15 minutes or something more. One of the things I'll say is I'll let Ashish take some of the more technical questions, but there are questions about getting a meeting with versus a VC, and I'll come back to the dynamic, right? That it is actually diligencing. Both sides need to diligence and research each other and do their homework, right? I'll give you an example. So we get, obviously this is a friendly audience. I'm a Thai charter member. Thai has been great. Ashish is also a key part of it. We've seen some pitches. These are don'ts. I've seen one pitch which has been sent to us with and marked 20 VCs on one email, right? So if you're talking about and that is an absolutely no, right? The best thing is I see all our friends copied, and I sent it to the team and said, okay, now we have all the other VCs email. Let's sell our companies to them. But I think what is that means that person is obviously, that's not the extreme where the homework is not done. It is not just doing a homework on the VC, but the particular partner, the analyst, or that we're all getting specialized, right? For example, I'll give you an example. Ashish, we all are generalists, but Ashish looks at fintech, for example, in particular, looked at some of the consumer businesses. I look at a little more of the cross-border enterprise, and hence, we've got Yugal Bandi on this call also. So I can't tell you the number of entrepreneurs sometimes that don't know that today we're a pre-A fund. We're not a micro VC that we were a year ago, or we'll get a proposal from somebody trying to start some like a chemical plant and looking for like some 50 crores, right? And what I mean is that it's them doing homework on us as much as we do homework on them. So I think sometimes a very cold email but very well written pitch, right, says, hey, listen, I saw some great, I'll give you an example. Arpit from our team was our principal. May know Arpit. He's quite, very prolific, well known. He's a co-founder of the Head Start Network. He's written now a thesis on space tech, around drone tech. Now, somebody has a space tech startup and referred that and said, hey, I would love to get in touch with Arpit from your team because I did this project at my undergrad in wherever, in Indore, and space tech has been a passion. That's great, right? I mean, we will look at that because it shows that the person has taken the trouble to research it versus do a blanket thing. So I'm saying that sometimes one can be creative. I mean, we are in the business of backing creativity, right? That's where we exist, and that's where you all exist. We are doing something that's non-run of the mill. We've got to deliver alpha returns, not general stock market returns, because then you might as well be in public markets. So everything that we do has to be different and thought through. So I'm just saying, never say never. There always has to be the entrepreneurs also have to do the homework on us. Ashish, I'll turn it over to you. Some more questions.
No, there was a question on IP valuation protection. So that is something that Sanjay mentioned earlier also, and I just so there are two parts to this question. One is valuation. if you are a business that is creating a solution for global markets, and you need to register IP in global markets, then definitely uh, you will get much better attribution from investors who are global. There is a better premia from global investors when it comes to recognition of IP in some areas. But having said that, there are enough companies like we have in our own portfolio called Grey Orange, Carbon Clean Solutions, Tricog, Locus, where you have meaningful IP and we've discovered these companies sitting here in India, Bombay, Delhi, Bangalore. So I would not over attribute and say it's only global investors. But at scale, yeah, you're likely to get a better recognition in terms of valuation. In terms of the framework on the regulatory side, things have definitely improved over the last 5 years, is how I would like to say, but things are far from ideal. So when you see some global investors, they'll still come back and say, "Oh, I don't think the IP will be better protected in India." Some of it is valid for sure. I'm not going to deny that, and therefore they insist that the company should be domiciled overseas, and some of it is a little overstated. So founders will have to take their own calls based on what their current situations are, what preferences their current investors have, and go about making some of these decisions. But at the same time, protection, if it's a global play, you will have to make sure that at each point in time you raise money, some part of the capital should be allocated for IP protection into different markets that you are going to go after. It is a healthy practice to keep scaling as you scale the business and open new markets. You keep putting your patents in different territories as well. That is the right way to go about it. In terms of exact premiums, whether it's 5x, look at early stage, these premiums can be much bigger. At growth stage, yeah, they do stabilize between 5 to 10x depending on the other qualitative aspects of your metrics on the B2B side. So one has to make peace with it. But in the early stage, it depends on the check writer and the stage at which you're raising. If the revenue is hardly revenue run rate on a monthly basis is $10,000-$20,000, you may still be able to command a $2-3 million post money. That's a massive premium, right? So it's at that juncture, it's about the investor's conviction in the market space and the founding team, and not just about the revenue. At $1 million of run rate, yeah, it's reasonable to expect that you should be valued at about 8 to 12x for sure. And if your metrics are phenomenal and your LTV CACs are going very high, then maybe even 15.
Sure. I'm just going to look at the last, last question from, not last question, the most recent question from Romit. It looks like, Romit, you're on to, something interesting, and wish you luck there. Generally, I think, when I look at our own experience with Milk Basket or Dunzo, I think it's important to really prove a user case and a customer use case, get it right, and then like go deep into it, make sure it works, that the customer's locked in, and then expand, right? Versus like skimming the surface. So if you look at the expansion plan, let's say you have rolled the service out in there, whatever, maybe e-commerce app, maybe a discovery app, maybe a grocery delivery, and if the customer doesn't have loyalty, right, and if they're very high switching costs, then you're going to expand globally. There's no guarantee, because you're basically, the investor is going to say, show me a business case that works, right? I'm not going to put money behind something till I am sure of the ROI. So rather than that, if you crack different cities, like if I knew that Bombay was cracked, and then you've cracked Pune and cracked Bangalore, the certain business model is proven, you've got to operational break even. Then I would love to see 3 or 4 points, cities done, and then you expand regionally, maybe globally, right? Versus skimming the surface. In one sense, the what's happened with SoftBank, if you leave, we just saw again that Oyo has raised money again from SoftBank. But if you keep that SoftBank phenomenon aside, I think it was actually the opposite problem of too much money chasing decent business ideas, right? So there's a danger of raising too much capital because you don't know where to spend it. I see a lot of young faces also, here, which is great. You'll have the energy, but I think it's important to responsibly raise and spend money. It's also our responsibility, right, to responsibly allocate that money. So I think I would always say prove something right and then expand. Of course, growth is important, right? But not growth at the without end in sight. And Ashish is spending a lot of time with our portfolio companies on getting them to operational break even, which is always important, and now in this scenario, even more important. Sumil, while we're doing any, so all of you have asked questions. Do we also, just before we wrap up, is there anybody who wants to put up the hand and actually ask a question, like dial in, or should we do it?
Let's just wait for a couple of minutes. If we have more questions, we'll go ahead, or we'll then wrap it up.
Okay, I am looking at some questions that we have not covered.
Meanwhile, to the others, if you have any questions, it's the time to ask them.
Yeah. So there's one question on TIE. I think this question on how about TIE if I'm not able to find the right connect with someone where Blume has invested, will this be helpful? See, I think, we get a lot of questions, on LinkedIn and requesting that, sir, you have time to mentor me. And I'll say this again, the family. I don't get time to spend with my own family. I don't get time to spend with our portfolio companies, right? So it's really difficult to mentor somebody I don't know, which is exactly where TIE is fit in and does a fantastic job, right? I mean, today we are a pre-series A VC. We basically invest typically about 6 to 7 crores to start with. It's rare that we invest less than $1 million. When we started, we were doing 1 to 2 crores. So at that time, we're also coming in much earlier. So I think everybody also has to understand that different resources in the ecosystem. What do you go to TIE for? What do you come to Blume for? There are other stage investors like venture catalysts, Sanjay Mehta of 100x, who's doing an interesting job coming in early. So there's a whole slew. It's not one size fits all. I think everybody has to research, and I think TIE is a great place to start.
So I will try and quickly take 2-3 just in the flow without over elaborating before we can conclude. I realized there were 2 or 3 to be answered. One was by Vijay on customer support as a service. So any scaled business, there are components of customer service that can be outsourced as a platform, and then there are some which are very core and innate to the business. To the extent these are outsourceable businesses and you can show certain ROI to the business and maintain the NPS with the customer, there's definitely no doubt that these can work. To what extent these are going to be SaaS based or what extent they're going to be operational heavy businesses will drive the extent of VC interest earlier on. The other other question that came about was, do you think it is a good time to start a smart savings platform? I think I answered that. And one there before was new online content like gaming, sports, etc. When it comes to gaming, sport, etc., when the Wi-Fi, when the data cost went down as low as they did, it gave rise to a whole bunch of offerings, including media, news, sports, live streaming, gaming, etc. We are at a juncture where I'm thinking that the rates would start going up a bit. So in that scenario, I think we have reached a juncture where there will be people willing to pay. So to the extent you are solving something niche and offering something with having a sticky engagement, there's definitely scope. So just a pure play aggregator, you might find it a bit tough in terms of getting subscribers. But again, the answer is a bit hybrid. People will want generalized content forms. There is a fair bit of orientation to short form content. So that is also an area which we are seeing a fair bit of traction, and it will continue to do well. In terms of macroeconomic hypothesis that Mayank was referring to, um, so we do come up with thesis from time to time. It is not necessarily at the beginning of the year. We take a very structured crack at it each time that we are starting a new fund, and then keep uh, assessing whether we need to add any specific aspects basis the pipeline that we see. If you realize that we don't have a thesis area on something we are seeing, we'll quickly put our heads down and figure out a thesis rather than saying that no, we didn't think about it 2 years ago, we'll not take it. So the idea is to be nimble and agile and look at it deeply if we have not looked at it earlier, and still evaluate it. Yeah, that's pretty much it. Unless I I missed, I'm happy to add. But broadly, I think we've covered it, and we are at 10 past 6. So happy to continue if there are more questions, or we can close.
I believe we'll take questions for the last next 1 or 2 questions, and then we'll have to wrap it up by 6:15. So if you
Thanks,
have,
Amit.
yeah, if you have any interesting questions like that you would like to answer, you can go ahead. Or meanwhile, we can wait for a couple of minutes for the next question to come.
So while I'm just looking at this very quickly, hardware startups. Interesting, right? I mean, Gray Orange Robotics started as a hardware startup, but what we're basically seeing is that wherever the founders and the team can see a business problem and build an integrated platform, right? We've got Tricog, which is a virtual cardiologist, has a hardware integrated with the cloud. Gray Orange today has AI and I mean it's embedded software that's enabled with hardware. So of course we will look at hardware only. Or also, the whole idea is, how does it integrate into the stack? That's one. Scope about agri-tech. I think agri-tech we're quite bullish on. The fact is that India 2 and India 3, rural, there are fintech aspects to that. We've done Procall, which is, a sort of a commodity, agri commodities platform. We've done Tartan Sense, which is precision robotics for agri-tech. Agri-tech is going to be huge, and I think technology plays an important role. Fintech also touches that. So while we're waiting, Ashish, there's something around payroll. And Ashish, more importantly, I think, I don't know if you addressed it, see that question around profitability. What is?
I will try and take.
That's a good one. I think that's a good macro one to even wrap up, right? Profitability and so growth or quick growth at the cost of profitability.
No, in terms of agro tech, somebody asked, Supriya, I think I very briefly alluded in some other context. I'll just quickly put a sentence or two to wrap up. Agro tech, yeah, we are putting money where our mouth is. We do believe in that space, and we have made 4 investments in agri tech businesses. So definitely, we feel that there is a future there. But there are multiple parts to that space. There is the pre-harvest. There is route to the directly farm to the fork kind of businesses. We've stayed away from farm to fork type of businesses for various reasons. Partly they are slightly intensive on capital, and we feel that it's a larger capital problem for it to be solved. And the other problem is also there are some micro political considerations there. As we see some of these changing, we definitely be okay with that as well. But other than that, in terms of mechanized robots on farms, in terms of financing solutions for farmers and supply chain units of farmers, milk supply chain, dairy supply chain, what I meant, we have done those plays and we will continue to look at those type of businesses. The other one, the last one that I'm seeing was in today's scenario with cases like we work apart from founders, etc., etc. No, so this is about, look, you meant to ask, despite we works is how I look at it, at least how I'm interpreting it. I hope I'm not getting it wrong. So I don't think VCs are supposed to work with founders to discover and identify new market opportunities. So early stage VCs particularly should be funding maybe a year or two ahead of the curve rather than wait for things to stabilize. If we have if we have seen a company and is already at a crore rupees a month, there's a good chance we might realize that we have run in late. So idea is to come in early. So if there are low margins at the beginning, but you know that eventually there will be a fair bit of scale, we don't really want to make we're not going to make a big fuss about it. There is going to be a tendency to look at it favorably. High margins, but not in a position to grow, is not something that VCs would look at it. But low margins at big scale, yes. But it should not, you mentioned it right, it should not be like a WeWorks where low margins would mean that it can't get to profitable outcome at good $5-7 billion and more of fundraising. So yeah, that is not something which is acceptable, at least not in India. And with Blume, we have had a penchant for efficiency as a benchmark. We have in Fund 1, we have half a dozen companies between Fund 1 and 2 which are making even our post profitability, and we're proud of it. Pre-launch funding, yeah, we used to do that, and maybe one-off we would continue to do in this day and age as well for our life, but much lesser in terms of volumes. There was
I think
Rahul has pretty much summed it up. Thank you.
Yeah. So firstly, now that we are concluding, firstly, a big thank you to Blume Venture team and Sanjay sir and Ashish sir for this session. This was very insightful for all the entrepreneurs coming on board, and I believe it was quite interactive for you as well. And also, I would like to point out that at one point we had about 84 or 85 viewers joining in, and as we end right now, we have 52 people who have been with us till the end. So all in all, I believe this was a great session. And to all the people who are still online, we'll be doing more of such webinars in the coming time, probably for a month or so. So we look forward to see you. And again, Ashish and Sanjay sir, thank you so much. And if you have any concluding words, please, you can go ahead. Thank you.
No, thanks a lot. I saw a few questions which veered around specifics on the process bit. So we have a services team that works with our portfolio companies and founders. We're more than happy to plug them into the system, and on the rotation basis, they can keep advising and guiding founders on things like diligence, shareholder contract, legal terms, etc. Feel free to leverage us on that. We'll be more than happy to connect you and have the Thai ecosystem leverage that.
Sure.
Yeah, I just want to say thanks. It was great to have Ashish and me both on this. These are tough and difficult times. I want to just say a quick kudos and fantastic work from Thai to put this together. I think we'll find that there'll be more camaraderie and more community built in these online Zoom moments, and we're seeing this everywhere. So thanks for having us on, and good luck to each of you, and stay safe, everyone.
Thank you. You too, sir. Thank you. Bye-bye.
Bye-bye. Bye all.
खाड़ू बता नहीं खा रहे